Hi, I'm Shay Russell from ABC Bullion, and joining me today is Nick Frappell, Global General Manager of ABC Bullion. Nick, how are you, mate?
Very well, thanks, Shay. Good to talk to you again.
Yes, it's good to see you. Now, it turns out that you and I have a favorite color, and it happens to be blue. So everybody, when they tune in to see these videos, it's just you and I in a sea of blue shirts at the moment, isn't it?
And the same shade, even.
Yes. All right. Now, I'm sure everybody doesn't want to hear about our wardrobe choices. They'd much rather talk about gold and precious metal markets. And we do have a lot to cover in a short period of time today. So first of all, let's kick off with the US dollar gold price. Now, at the time of making this video, gold was sitting at around 1,759 US dollars per ounce. You and I have used the phrase that it seems to be hugging this 1,750 mark, and it's reluctant to budge. Gold
right.
isn't going anywhere. It's not really going up and it's not really going down. For lack of a better way of putting it, what gives?
I think the two things that really matter are that you're getting a rising trend in nominal yields, and that's making the dollar attractive still. And those things are negative for gold. It's difficult for gold to rally in the face of a rising dollar and rising yields. At the same time, there is an element where as time passes, we're getting more information that suggests that inflation is less transitory than the Fed had been saying, perhaps a quarter ago or in the first half of the year. That's keeping a bit under gold, as is a certain degree of physical demand. So that I think, to me, explains why gold is kind of in this slightly sort of no man's landish area. Now, the other thing is if you look at positioning, everything else that's going on in asset markets seems to imply that the sort of CTA, the managed money sector, really isn't that excited about gold. They're around about 12 million ounces long, futures only, and shorts have just declined a little bit to 7 million as of the last reporting point. That's telling me that people aren't really looking at gold at the moment and saying, I must be committed to positioning in this metal. But there's things that are keeping a bit under it in the face of a certain kind of headwind, namely the strong dollar and rising nominal yields. 10-year yields, we probably would look at moving towards about 1.75%, just to put a number on that.
All right. So before we touch on some of the factors supporting the US dollar at the moment, let's talk about silver. There's been a heck of a ride south, and we've seen a little bit of a rally come back. I think at the time of making this video, it was sitting around the $22 per ounce mark. I know you talked about it in our recently created podcast that some of the long-term forecasts for silver have been completely taken out. Let's run that technical lens of yours over the short-term price action of silver. What's the short-term picture for the silver price telling us at the moment?
Well, the really important thing is that silver, when it dipped, it held the base of the weekly cloud, and it's kind of slightly started to ride up that weekly cloud base. So it's still bullish, at least from a weekly, I'd say, sort of a medium term view. Obviously, it's got scope to go lower because it's kind of hanging on some really, really key supports right now. It needs to hold those levels around about where we are here and start to recover. That might be a little bit contingent on what happens with the copper price, for example, and whether people perceive that economic growth is going to help support the case for silver through basic demand. Obviously the factors that are affecting gold, with the fairly well bid dollar, the fairly well offered bonds, those things are obviously creating a headwind for silver as well. But I've kind of, been optimistic about silver, perhaps, not too long, but certainly been optimistic. It hasn't done anything yet that's, going to suggest a big move lower. It needs to hold the current levels for sure.
Now, I was going to get to the US dollar right now. However, I'm just going to change track just slightly. I know you love it when I do this on you. You mentioned managed money isn't particularly excited about gold at the moment. And obviously managed money isn't particularly excited about silver at the moment either. What do you think is going to encourage managed money to move into this sector of the market or back into precious metals?
Look, I think one of the things that's going to matter is what happens to stock valuations. They've obviously sort of, had a little bit of volatility, distribution around the last few weeks. Where we go with inflation, but of course some of these things will feed through fixed income markets first. So for example, inflation is supposed to be good for gold, but if it's weak for bonds, the bond market will kind of take precedence. Yields should rise, and that would just create another headwind for gold. So what you might see is a little bit of a stepwise action where some of the positive news for gold might actually create a bit of volatility first via its impact on fixed income, equities, and so on. The other thing that I think would matter is if there's an increase in political risk. We've seen a lot of jaw burning from the People's Republic lately, kind of testing the waters, I guess, or maybe employing diversionary tactics, I would suggest, given that there's a few domestic issues going on with energy, property, wealth effects, and so on. Those issues also should perhaps give a more, perhaps imply more interest for gold. We haven't seen that catalyst yet, but basically those are the things I've looked for. Also, the other thing is that as we go into the end of the year, we saw some pretty soft data from the non-farm payrolls last Friday. I think that's honestly, it's not going to affect things like tapering and so on. But if there was a real run of weak data suggesting that actually the US economy is slowing down, then I think you'd start looking at, okay, maybe earnings are going to weaken, maybe overt tightening is going to be delayed. That might make investors and managed money start saying, okay, maybe we should have slightly heavier weighting towards gold positioning and perhaps silver positioning.
Onto the US dollar, let's talk about the DXY. Now, the US dollar has remained strong. And, as you mentioned, tapering is, well, we believe soon to start. But, it sort of baffles a few investors about why the US dollar is remaining so strong when you could argue that there's things that should be dragging it down, but it's not. It's sitting around 94. So from a technical point of view, do you see any further upside in the US dollar? Or can we get bearish about the US dollar just yet?
I still see further upside. There's some sort of, reasonably good arguments on, both sides. I am largely bullish the US dollar and have been for much of the year. I think that if you look at the short term, and we're talking about the dollar index as a sort of proxy for the whole of the US dollar. This week, I think around about 95, I think we come into contact with the weekly Ichimoku cloud. That is a pretty decent resistance level. So you might see the market consolidate or reject that level in dollar index terms. However, if we break through there, then I think the dollar could carry on appreciating slowly, not necessarily dramatically, but it is kind of, in yield terms, it's one of the best shirts in the laundry. So I think that always helps. And what we need to see is how the next, I guess, this is not necessarily, important if you're looking at the US dollar in terms of, hey, what's happening next week? But if you look at what's happening over the next quarter, the next half, then US growth is likely to remain, I suspect, remain higher than its peers. The other thing is, as well, is, obviously there's issues occurring elsewhere which may promote the dollar. And for example, that is, issues around the Chinese property market and so on. Chinese property and perhaps slower growth might impact through energy issues, perhaps in the EU and China. So I'm still pretty friendly to the dollar, but that 95 level in the dollar index is one that I would be looking for.
Nick, we're going to add one of the best shirts in the laundry to my favorite list of sayings of yours. That's another great one you've busted out there. We are going to talk about Evergrande. That is going to be my final question for today. But before we do, I do briefly want to talk about the Aussie dollar. I mean, look, let's be honest, since the middle of August or even the start of August, it's been a wild ride for our currency. Now, in the past couple of weeks, it's rebounded from its lows of around 71.50. At the time of making the video, again, it's looking at 73.45. Again, what is driving this volatility in the US dollar, and where is this strength coming from?
Well, I think the Aussie hit a good support level, or came very close to a good support level. I think it was the 0.382 fib retracement of the March Fed movement, which I expected to be a level where the Australian dollar would find some support. Now, got to give a bit of a hat tip to the guys at Deutsche Bank, because yesterday we looked at a chart that they had produced, which I really liked, which was comparing the Australian terms of trade, which look great because of still reasonably good iron ore prices and so on, versus positioning, which is really low, and saying, look, in terms of trade, say strong dollar, the bets say that dollar expectations are for a weaker dollar, but of course those shorts are always sensitive to buying back, taking profit, or being squeezed out. There was a real dichotomy there in that chart, or divergence, if you want to call it that. That I thought summed up pretty well why there's volatility around the Aussie, and part of that volatility as well is shifting emphasis on risk on, risk off. There's been a lot of that, particularly with regards to our largest trading partner. That's one thing. The one thing I'd say about the terms of trade sort of lens for looking at the Aussie is, of course, it has been fantastic for much of this year. But going back to the sort of the bilateral trade with China, that would be a cause of concern, because you'd think on a forward-looking basis, Aussie dollar bears would be looking at terms of trade saying, that doesn't look like something that's going to improve. It's already been very good. Reopening may diminish the terms of trade or blunt the powerful terms of trade numbers. They'll sort of have a sort of a slight reset there. But also, again, going back to the big E, if there are issues around real estate in China, then you've got to think that is a negative for Australia's terms of trade. And that may explain, of course, a lot of the positioning too. I've totally left out the RBA in that, because it's a bit opaque, and I'm not really, that's a whole other story.
We can save a deep dive into the RBA for another time. And look, I know everybody in Sydney is starting to come back into the office, so I'm sure that we're going to need to wrap up in a minute, but I do want to touch on something very important right now, because I think, well, its importance is debatable, but I think it's becoming more important by the day. And this is what's happening with Evergrande. Now, not only has Evergrande defaulted, but as you noted during our first podcast last week, there has been signs of contagion into a much smaller property developer that has also defaulted on their offshore bonds. So can I get you to elaborate a little bit about what you see happening in the Chinese real estate sector right now?
Well, I'd say one of the main things is that the paths of propagation in the real estate sector, as kind of as we expected when we discussed this over the last couple of weeks, and also the short sort of white paper that I did recently, is that basically it isn't necessarily going to affect the banking sector. It may affect the banking sector in a greater and greater form, but it isn't like a sort of a wildfire effect there. Where it's an impact is through other real estate firms, where people are becoming extremely risk averse towards rolling their financing. So you're seeing incredibly high yields in Chinese offshore high yielding bonds. You're seeing propagation to other issuers that aren't really that affected, but now people are generally risk averse because they might think, well, is there a connection, or I don't really want an exposure to that sector or even adjacent sectors. So look, the size, scale, scope of the problem is still really, really dramatic. Nomura did an interesting piece recently where they estimated the size of total Chinese real estate debt at about 5.2 trillion US dollars. If you look at the scope of defaults so far, that kind of suggests that, well, things are fine because, we've only defaulted in the scope of billions. I mean, I'm being a little bit, tongue in cheek, but the point is this is a slow motion issue, and the light at the end of the tunnel is nowhere to be seen, and what we see is just more dominoes falling very slowly, some of them quite softly, but nonetheless issues. And looking at I'm doing my sort of monthly report, and I've sort of put a few bullet points in there about just how Chinese sales are plummeting in tier 1 cities. So literally the sales in the last few weeks, those sales of square meterage in Chinese tier 1 cities absolutely falling over. That is a horrible sign if you're in the business of selling real estate and you'll leave it up to the moon.
Look, Nick, I'm going to have to wrap it up there, unfortunately.
Yep.
I know you've got to get to a meeting. That was fantastic. Thank you very much for those insights. And I really do like your take on the slow motion unraveling of real estate in China. So once again, thanks very much for joining me.
Thank you, Shay. Speak to you soon.
Thanks, Nick.
Bye now.